Welcome to the Stewardship Leader Podcast, brought to you by the Christian Stewardship Network. CSN exists to teach and equip church leaders the biblical perspective on finances so they can speak with authority, confidence, and integrity. To learn more, visit us at christianstewardshipnetwork.com. Hello, everyone. Welcome to Stewardship Leader. I'm your host, Leo Sabo, and today I have Dr. Shane Ennett with me. He is back for the second of a four-part series on investing. Last week, we talked about the history of investing, and today we're going to continue with the philosophies and strategies of investing. Shane, again, thank you for taking the time to come back and share this with us.
Yeah, thanks for having me.
Well, Shane is the assistant professor of finance at Biola University. He's also written a book, Whole Heart Finances. This is a great book. It's about finances, but it's a whole heart finances because finances are about the heart. He also has a wonderful website with a experience that you can go through to understand biblical finance and also understand how it pertains to your relationship with God. That's really what this is about. I encourage you to check that out. It's wholeheartfinances.com. Shane, I'm just going to hand it off to you and let you jump into the next topic. I'm excited to hear about this philosophies and strategies of investing.
Yeah, no, thanks. So last podcast, we talked about the history of investing and how things evolved over time. And here we want to talk about what investing is exactly in today's culture and how it's expressed in terms of different philosophies that lead towards different strategies. And then the next podcast, we want to talk about how that all parlays into kind of the modern Christian marketplace, which is largely in response to kind of philosophies and strategies. And then lastly, in our last podcast, we'll talk about what's happening in the future of investing, what's expected, what could happen. Today, we're going to be really focused on the expression of investing in today's marketplace, just overall, and what are all the different competing philosophies and how that leads towards different strategies of investing. And for me, I've been so fascinated with investing at an early age. It was really when I was 15. My uncle, he gave me this book, How to Invest 50 to 5,000. It's a classic book. It's been, updated at least 12, 15 times. And it was the fact that the dollar number was so low. So as a 15-year-old, $50 felt reasonable. And then I couldn't believe, that I could do something with this $50. Like there was something I could do besides just go to the bank. I had my little blue book. You earn, back then it was the normal 5%, which I guess is right now as well. But I'm still used to the 0% world.
Yeah.
But yeah, so I've always been fascinated with what should you do with money? What should you do? And you can spend it, you can give it, but like if you're saving it, how should you invest it? And there's so many things you could do. I mean, there's so many, and every year it becomes a bigger and bigger array of choices. And really, how you choose what to do with money, particularly in investing, it has to do with your philosophy. And your philosophy is a set of core beliefs, values, or principles that reflect your worldview. It reflects your idea of purpose. And once you have that, and for most people who invest, they're operating under someone else's philosophy. They don't quite realize it. They're just kind of going with the flow. And then that leads towards goals. Philosophies, lead towards a goal, an objective that kind of aligns to the values that are based on the philosophy. And finally, once you figure out your goals, then you create a strategy around meeting those goals. And so I want to kind of flesh that out in the investing world. For me, all of, the beginning of investing should be about the philosophy, and it should be about a seeking of truth. What's true? And I think not enough people ask that question. I mean, partly because they're intimidated because investing is a lot of terminology, but in the end, what you do with investing should be, you should operate under a certain conviction that what you're doing is true and avoid doing things that you feel like are not true. And so I want to kind of also flesh that out and see, what does that mean, to have investing operate under kind of statements of truth. The biggest mistake people make in investing is they kind of don't decide. So they maybe hear about certain philosophies, certain truths, and then they actually try and do both truths, and they're actually competing. So every kind of truth statement is a competing truth statement. And so there's philosophies of investing that you shouldn't try and do both of. Because if you choose to do multiple strategies, you're actually going to kind of defeat yourself right at the beginning. And you need to kind of choose and pick one. Let's take tennis. So in tennis, there's strategies for winning. The two primary ones are staying back and being defensive and letting the other player kind of make mistakes and just trying to avoid the mistake. And the other strategy is my favorite tennis player, Pete Sampras. I loved tennis in the '90s, and so he'd charge the net. He'd go right up there. He was so tall, he would just kind of like defeat everyone by charging the net. But you can't decide, oh, I'm going to be defensive and I'm going to charge the net. Most people who aren't quite decided, they end up in the middle of the court, and so they don't have the benefit of either strategy, and so that's a losing bet. In war, you have two philosophies. You have the blitzkrieg, which says speed will exploit the enemy's weakness. You have to be quick and decisive, and that minimizes costs and maximizes impact. But the alternative strategy is attrition, where you say war is about endurance and strength, and you have to grind down the enemy, and that's a patient game. So the worst thing you can do is start a blitzkrieg and then decide on attrition, and you're basically going to maximize your losses. Lastly, just because I've been watching football, you can build your team around defense wins championships, or you can build your team around scoring to win. Like, you have to actually score to win. So in investing, I'm going to start with the biggest competing philosophies slash strategies that is out there right now. And to me, these two competing strategies that are based on philosophies are you have to choose a side. If you don't choose a side, you're going to lose. And it's like an epic rivalry. So in my mind, these two philosophies are like Miami versus Notre Dame, or, and I'm doing Florida for your sake here, or Florida State versus University of Florida, or for me, USC versus UCLA. But their two philosophies are called growth versus value. And what I've noticed and what I've seen and read is if you try and do both, you're going to lose. They're mostly amoral. They're not like a sense of one is going to align to biblical worldview and one isn't, but they are philosophical. And so let's kind of work through that a bit. And my conviction is you have to choose a side. And so I chose a side, and I chose the value side. So everything, as I kind of explain these philosophies, you're going to hear some bias here. Just like if I'm going to talk about USC, I'm going to be super biased.
Yeah, of course.
So anyway, so at the heart, when you're looking at a company, you're looking at their earnings. Do you want to pay a discount on those earnings, or are you willing to pay up for it? This is really about two philosophies of viewing a company. And you see this in life, where is someone, let's say they're looking at an auction for something they want, let's say an art piece or a collectible. Are you the kind of person that if there's a big bidding war, you get excited because that means people want it? That must mean it's good. Or would you rather have no one there and you find something that no one else knows about and you get it at a discount? And that's what gets you excited. So value would say is a contrarian at heart. Hate fuels you. You love hate. Hate is something that you're going to buy something at a discount because everyone hates it and everyone is just has overhated it essentially. And so for me, when people are hating on something, I get excited because I'm just more of a natural contrarian. I really want to buy things at a discount. I'm a super cheap person by nature. If everyone's excited, everyone's like, oh, Bitcoin, crypto, Nvidia, like that kind of gives me a bad taste in my mouth. So that means I'm like a value philosophy through and through. I want to buy earnings at a discount. What that means is you want to buy a company at a low PE ratio, broadly speaking.
Okay. Define that a little bit for our audience. And when you're talking about company, we're really talking about stock. So if you just kind of break that up just a little bit so people know the context we're talking through.
Yeah. So, and philosophies of investing, I'm talking largely about just buying stocks. And personal investors will kind of adopt a philosophy. And, if you have ever heard of Warren Buffett, and if you ever read anything by him, he is one of the poster child of value investing. And so PE ratio is one of the largest kind of indicators that investors look at. And it looks at the stock price, and then it divides that stock price. And the stock price is what a willing buyer is willing to pay a seller. So it's an agreed upon price between a buyer and a seller. And it's the latest one is what you see. And so that price is divided by the earnings of that company, the earnings per share. If you buy a share, you now have the right to the earnings of the company. So how much are you going to pay for those earnings? That's the PE ratio. So PE on average in the US economy is around 18. At least historically it has been. It's more now. But what that means is for every dollar a company makes a profit, you pay $18 for that. If you're a value person, you want to pay less. You want to find a company that's earning a lot, a profit, and then you get to buy it at a discount. The only way to do that is everyone's got to hate it. They got to hate it. So like Warren Buffett was going during the tech bubble of 2001, he was buying textile and railroad companies when everyone else couldn't get enough of .com. And that's like classic value. And so in today's worlds, you have to think, all right, well, what does everyone hate? I don't know if you can think about an out of favor industry right now. I haven't prepared for one. In class, I always throw a lot of shade on Wendy's because I don't like their square burgers. So I always have that as my example. but but yeah, an out of favor industry. I mean, maybe real estate if rates don't get cut, and then maybe
Oil and gas, are they out of favor right now?
potentially. It depends. Yeah.
Depends on who you're talking to, I guess.
Yeah. So let's just say everyone's thinking interest rates are going to stay high and that there's too many headwinds with home builders. Then a value person would say it's overblown. Like people always overblown their reaction. So when things go down, it goes down too much. Whereas when things go up, it goes up too much. So you're kind of, if you can buy things at a discount, you're protecting yourself from a risk perspective. And that's the first true statement I'll make. One true statement that I really like aligning to is just greed and fear, that human nature doesn't change. And because of greed and fear and the nature of kind of a stock market and how money flows, is that people will always, when they're excited, they'll always pay up for it beyond what it's worth. And then when people are scared and fearful, they'll always sell it beyond what it's worth. And
Yeah.
that creates an opportunity. And in my mind, greed and fear create more opportunities for a value philosophy than the growth philosophy, which you can ride it. You know, a growth one, you could say, well, everyone's excited, so I'm going to ride that wave. But I don't like, you're actually, that risk that you're exposing yourself to isn't compensated as well, because the higher you go, the larger the fall. And whereas value, you know, you buy it, it's either going to survive and go really high or it's going to go bankrupt. And so if you just buy 10 of them, probably only one is going to go bankrupt. So the other ones are going to have a bit of a hockey stick growth when people realize it's not as bad as you thought. Again, I'm completely biased here. And value, let me give this caveat. Value has been the worst performing style. They call these styles, these strategies. People who have been like me have been getting fired all over the place because value has not been doing well. Partly AI and I don't know. There's been so many things like post-COVID growth. Just the stock market had its longest period of an up cycle that in the history of capitalism.
Hmm.
And when everyone's frothy and excited, that's very bad for value people. They just are not going to do well relative to growth people. So growth people have their heyday with AI and with new technologies and with new products. And when there's favorable interest rate environments, when there's good GDP and good socio-political kind of things are stable. The birth person of growth, modern day growth investing, his name was Thomas Rowe Price Jr. And he's called the father of growth investing. But he was just focused on prioritizing companies that are reinvesting their earnings, expanding, doing research and developments, using acquisitions to fuel growth. Really, it was post World War II that fueled the boom in growth philosophy. So what value will say is, let me look at liquidation value. If I can buy something at liquidation value, then I'm protected by a stock. If you sell the company and I'm buying it at that cash value, then you kind of have a floor. It can't go beyond that. Growth is like, who cares about liquidation value? Like, this company already, it's new, it's not worth anything, but the potential is amazing. I'm willing to pay up for that. So Nvidia would be, or Tesla would be a good example of, like, they don't have assets necessarily. I mean, now they do, but like before, it was all promise and not necessarily, you can kick the tires and look at the value of it. And so you have these two philosophies about, you need to kick the tires. You need to buy something that is already generating profit, is established, is safe. You're managing risk. You're taking advantage of greed and fear, versus this other philosophy that says, find what's growing, find the story, find these amazing new markets that are emerging, and be a part of the action. And that's a riskier venture, but it also has higher payoff. But then if anything goes wrong with the economy, it does really poorly. And we haven't had our stock market crash that I've been expecting as Professor Doom. My students are like, I always get so excited when the stock market goes down. As a value guy, that's what I want. But anyway, so those are, to me, two big philosophies. And yeah, Leo, where would you say you are in that?
I also look at value probably more so than growth. Like you, I'm older, so I've tried to play both sides. I also realized that my what Warren Buffett has made somewhat famous, my circle of competence is limited. I don't know everything about AI and all the other things that are going on, and I would say I lean on that. Although I will tell you um, that I do sometimes look at growth companies and think, well, if you have the ability to understand the value of the company or the potential, is it worth? Sometimes it is, of just saying, okay, I'm not going to put my whole, you know, everything in that, but I'm going to put a small amount just in case and see what it does. So when you look at companies like Tesla and some of these, AI or whatever it is, they have great potential. They may be the next Google, they may be whatever. And that's where I think sometimes I'm kind of drawn to, like, is it possible? But I'm very cautious as well. I'm not a person who likes to gamble at all. So anyway, that's kind of where I land. I would say 90% in the value, and every once in a while, I'm like, maybe growth might be a worth the risk here.
Yeah. So I was a professional value investor. I'd spend 40 hours a week for a month on one company, valuing it, figuring out its intrinsic value, if you will, which is kind of like, if you model all of their expected cash flows, and then you figure out a fair price to pay today, that's a price, and you compare that to where it's trading at. And if you think it's worth more than where it's trading at, then you get to buy it. Yeah, the Warren Buffett, or before him was Benjamin Graham, called it a margin of safety. And so for me, as a professor doing something, I'm not a professional, stock analyst, and so I'm not gonna try and do that. I'm not gonna pick stocks because I don't have that kind of time. Before I had access to their CFOs, the CEOs, I get all the best models. I'd have all this good conversation with colleagues. So you can pay other people to do it, and that's called a mutual fund. And so my big conviction about growth versus value is, I like to pay a really good value person to pick value stocks, and then I don't mind paying a really good growth person to pick growth stocks. What I do mind is buying what's called core, where you just have a manager trying to do both. And I think they're going to be an average to mediocre value picker and an average to mediocre growth picker. Because I think pure value people like Warren Buffett, they can't do growth. Like, but when they do value, they do it really well because they just stay true. It's like I think so much of it is aligned to your personality. And so, like, a good core value person is not going to be a good growth person. And same with growth. A good core growth person, they're going to get so bored with the idea of buying a textile company or an oil and gas company. And so they'll avoid the really good value stuff, and they'll actually buy bad growth things if they're being tasked to buy value things. So I never mind the idea of, even though I don't personally like growth, of diversifying. and finding a good growth manager to give money to, and finding a good value person. And then just, going 50, I'll probably go 70-30, just because there is a lot of studies that show value outperforms growth over a long period of time. Those are being debated as we speak because value's been so out of favor for a while. Another true statement is I don't ever want to buy something I don't understand why it goes up or down. So if you imagine a real simple case of, you have your neighbor, he's your best friend you've grown up with. Every time you have his pizza, you're like, your pizza is the best pizza I've ever tasted. You should go into business. He picks out a corner store in a neighborhood you understand. You understand exactly, if you're going to finance that, why it's going to do well and why it's going to do bad. So you understand if it does well, why, and if it doesn't do well, you understand why. Like, most people can wrap their brain around how a food service company works. Um, Compare that to when I was valuing companies. I was asked to value Cisco Systems, and it was like I kept going around and around and around, and I still don't understand what makes this company succeed. And nowadays it's probably a little easier, but back in the 90s, like, I just could not wrap my brain around, why would this company succeed and why wouldn't it? How do you gain market share? How do you lose it? How do the competitors come in? What's the pricing? All of that, it didn't make any sense to me. And so even though it was doing well, I chose Home Depot because I felt like I understood why that does well. I did not understand Cisco. Yeah, I just think it's a good humility about investing. And I remember my dad asking me about Bitcoin, and he's really technologically savvy, and he knew everything about Tesla. He was very good because he was a chief architect for AOL at one point. So he knew all about the technologies. So he was very confident in his investing in Tesla, but he was thinking about Bitcoin. And I was telling him, I'm like, there's just, it's like predicting the weather. There's no way you can really know why it goes up or down. And so thankfully, I think that resonated with him, of like, let's just make sure you understand before you risk capital, God's money that you're stewarding. Make sure it's not just speculation. Make sure you actually know the business model behind it, because you're an investor, and it's bad stewardship if you don't really know what you're investing in.
This episode of the Stewardship Leader podcast is sponsored by Christian Financial Resources. Christian Financial Resources is a not-for-profit organization with a mission of funding ministry, changing lives. CFR assists independent Christian churches and their associated ministries. Since 1980, hundreds of ministry projects have received funding through CFR. These projects include land acquisitions, loan refinances, and the construction improvement of church buildings, parsonages, schools, and various other facilities operated by those congregations. CFR currently manages more than $880 million in total assets while serving over 7,000 investment accounts. In addition to loans and investments, CFR offers stewardship services, donor advised funds, legacy planning, life income agreements, capital campaigns, and generosity initiatives. Learn more about us at cfrministry.org.
Yeah, I like that. And I want to highlight that for our audience, because sometimes we can get wrapped up in the reason we invest in the first place and don't go back to the core that, hey, this isn't ours, we're stewarding it. And is that part of my stewardship, right? And doing due diligence, obviously, it's important. Picking the right philosophy, understanding, asking the questions, and knowing what kind of truth are you seeking. But ultimately, though, it does come down to, is this something that we're doing outside of God's influence or counsel? Or is it just something that we are absolutely saying, Lord, if this is something that will help me to accomplish the things you've given me to do, then obviously I'm going to pursue it and do it in a wise, prudent way. I'm very glad you said that, because I think it's easy, even in this conversation, for people that are listening to say, okay, so value sounds like it's a better option. Maybe a mixture of 70-30 sounds like that. You know what I mean? People could just walk away from that. And I don't want people to walk away thinking, okay, this helps me to be a better investor, without hearing the fact that I'm still a steward of everything God has given me. And that's my foundation for everything that I do, the decisions I make, and the philosophy I adopt and then live out. That should not change.
Yeah. And just so people who aren't as familiar with mutual funds, the name of the mutual fund will usually tell you what philosophy. And so most mutual funds where the portfolio manager is like me and he's like passionate about value, he'll put value in, him or her will put value in the name of it. And so it's a value fund because it has a value. It's like so and so fund, value fund. And same with growth. Usually you'll see growth in the name of it. Rarely do you have a fund that's a growth fund or a value fund that doesn't have it in the name. So you can kind of identify, and it'd be a whole long podcast to give the tips and tricks of finding the right portfolio managers. I love teaching that. But in general, if you go to morningstar.com, they have a style box. And so if you find the style box, it'll show you the PE ratio, the average PE ratio of the stocks that that manager owns. And so if they're really high, again, that's the price you're paying for the dollar of earnings of the stock. That means they're a growth manager. And if it's really low, that means they're a value manager. So yeah, but I want to walk through a few more philosophy perspectives and just kind of like go over them real quick, if that works okay.
Yeah, let's do it.
So there's value versus growth, which I think so much of investing, you can just draw a line in the sand and everyone should choose a side. And partly one reason why I was able to get for me, my dream job out of college was I knew my style. And whenever I went, I only interviewed with value shops. And then when I was in a value shop, I touted it. I was the kind of like the number one fan, and so it was really important because it's a culture fit. And so you want to know kind of what's your culture fit in terms of your investing style and what kind of people you want to align to. Besides value and growth, another kind of way to draw a line in the sand is top down versus bottom up. Top down really, it looks at the world as a whole. So it surveys the world and says, what's going on in the world? What kind of macroeconomic trends are happening? What countries are growing? What sectors are doing well? And it's surveying the world and trying to see what does best, and let me move towards that and drill down. So right now, if we were kind of looking at the world, we could say, I don't know, Mexico could be a good, if they can kind of clean things up with their new presidents, then or maybe even Venezuela could be really interesting. But just kind of seeing places that potentially have a lot of room for growth, where they're at. And this is the value idea of like what's been doing bad and that will go up, or what's been doing well for a while. Let me just kind of hop on that train. And so then you find the right country, you find the right sector in that country, and then you find the best company within the sector, within the country. And so usually top-down investing are usually economists, people who know a lot about how economies work, and they think a lot about risk and try to manage the risk. And they usually get into really complex financial instruments. Like if you've ever watched The Big Short, all of the things they tried to explain, they do all of that. And they call it financial derivatives. And so the most famous top-down person is, his name is George Soros. He would look at global currencies, and he actually, he's famous in many countries for the wrong reason. In a lot of Asian countries, he actually is known as the devil. Not just the white devil, but the devil, because he helped bring down a few currencies. He brought down the pounds. That's his most famous example. And so through his investing, he can put pressure on a currency and then bring it down. And but Ray Dalio is kind of the new macro guy. He runs the largest hedge fund in the world, and he pioneered a lot of really fancy strategies. But it's essentially, just kind of looking at big trends. Bottom up is mostly aligned. It's also called fundamental analysis, and that tends to be aligned to a value philosophy. But you can be a growth person that's bottom up as well, where you're just you're kicking the tires of the asset. You're looking at it. You're seeing what's the potential of it. You're focused on, you don't really care if you find a good company in a bad country. It's a good company, and you'll kind of understand, you'll discount it if there's some bad geopolitical, headwinds, but you can still find good opportunities in bad places. That's the idea of it. And so, Warren Buffett would be a good example of a bottom up. Benjamin Graham, probably the most famous for doing bottom up investing. If you were to kind of go to another line in the sand you can draw is active versus passive investing. So active investing means you want to find, you yourself are picking stocks, or you find a manager and you give them money to pick stocks. And so they're going to look at an investable universe. So all of the different stocks you could pick, and then they're going to find the best. That's called active management. If they're going to spend all this time finding the best, then they get a fee. So the traditional fee for a manager is about 1% of your money. And it's come down quite a bit because of this other philosophy, which became possible kind of in the 70s with the advent of computers, which is called passive. And that's where, instead of trying to pick stocks in the investable universe, buy the investable universe. You just buy all the stocks, and then you basically buy the market, as they say. So passive means a computer will use, good algorithmic trading, good technology, to then buy a representative basket of the whole stock market. And so then if, the most popular investing product in the whole world is the S&P 500 index, and a few different companies will have a product where you tell them, buy me the top 500 companies in the US. So the Standard & Poor's is a company that creates a list, and they have some criteria. And that list, you have to have a certain amount of history, a certain amount of revenue, a certain amount of stability. You can make the list of the top 500 companies, Tesla, Apple, McDonald's. And so either you pay someone 1% to try and pick the best stocks of those 500, or you just buy the 500. And you know how much, tell me how much it costs to just buy the 500 versus 1% of your money.
How much does it cost?
Yeah. Like, what's the fee? Instead of 1%, what's the fee of buying just passive?
It depends, I guess, but it's usually like 0.1% or
Yeah.
0.15, or it's like a tenth. Yeah, it's super low.
Yeah. It can go down to 0.02, 0.01. I mean, it's like pennies. It's like half of a penny, essentially. And so you avoid the fees, and the math is incredible in passive investing. Some years you beat up to 90% of all active managers just by owning the market. In general, you tend to beat around 75%. So some people are like, instead of me trying to find a good manager, let's just not even do that. Let's just be passive and buy the market. And John Bogle in the 1976 with the Vanguard is a company that created a fund that bought the S&P 500, and that was the first one. And that really has been the most popular product, since the 90s. And there's a problem with this passive investing. The philosophy is, let me just buy the market. I don't have to worry. I'll beat most of these other people. There's less fees, less risk because I'm well diversified. It aligns with academic literature. There was this concept called the capital asset pricing model that showed that you got the most amount of return with the least amount of risk if you just bought the market. And so there's so many things in favor of going passive and just doing that strategy, and just kind of saying, let me not try. And let me, by not trying, pay less and beat everyone else. However, yeah, what kind of, based on our conversation last podcast, what's a potential problem with this passive investing that you can see?
Well, I think just my limited experience. I mean, obviously, you're a couple of things from a standpoint of you're buying companies that you may or may not really want to invest in. From a moral standpoint, you may believe these companies aren't quite doing the right thing, or actually maybe doing harm. So from that perspective, there's that. Also, when you're investing, obviously, it's always a time situation. So if you're getting older and all of a sudden the market crashes, and you're invested in that, and it takes a big dip, you could lose a significant part of your portion, and that may be just at the time when you're starting to take retirement. At least those are the two main ones that I see.
Yeah, and you kind of hit it at the first point for sure, where we mentioned in Genesis 2 how we're supposed to work the land. And passive investing, what's so cool is all of these companies are getting capital. All these people are funneling money. It's getting sent out to these companies. as they're getting bigger, they're getting cheaper financing. And so that's rewarding these companies, but it may be rewarding them for no reason, just because they're in the index. And so what we're not doing is we're not watching over the land. And index investing actually like creates that loss of innocence. It exacerbates it. It accelerates it, where we're farther and farther away as an owner of the company, because people don't realize when you buy a stock, you actually are owner. You're a part owner of the company, and so that relationship is getting further and further kind of separated. And passive investing really accelerates that. So there actually could be, you could say there's a morality to passive investing, where God wouldn't want us to just give our money to companies without looking at what they're doing. And and so that leads towards the Christian response, which we'll talk about next week. And I don't think you get rid of passive investing. I just think you start to modify it a bit, and you create new lists that are, S&P 500 is a list of the top 500 companies, but a Christian could create their own list that mirrors it, but then also is consistent with a biblical worldview. And we'll talk about that next week. But that's just one reaction to some of the downside of passive. And there's a few other downsides I'll just mention. You mentioned sequence risk, which is this idea that as the fund does really well, then usually it's you become a natural growth investor. So passive investing, if it's weighted traditionally the way they weight the different companies, you actually de facto move into a growth philosophy. And so people who own the S&P 500, they're all of their exposure, almost all of it, at least half of it is Nvidia, it's Tesla, it's these things that are growing. And so then they don't know, and this kind of speaks to the comment I made at the very beginning. So many people don't know that they're involved in a growth philosophy, and they just are. That's just what happens when you're in what's called a market cap weighted index, and so you become a de facto growth investor, and then now you may or may not agree with that, and then you may own all these companies that are funding pornography or funding abortions. Companies create culture, and so you may be creating culture that is not consistent with your conviction. But we have time for one more.
Sure.
So there was active versus passive. The last kind of fundamental strategic difference / philosophical difference that you'll see, that I've seen, is this idea of technical versus fundamental. And I kind of said bottom up was basically fundamental, and that's true. So fundamental is like where you're kicking the tires, you're looking at the asset, you're trying to figure out what it's worth. But technical, so if you ever heard of day traders, or you've heard of technical analysis, what a technical philosophy says is, I don't need to know anything about this company. I don't even need to know the company name. All I need to know is, how has this company been traded in the past? What's the price of this stock? Let me look at the pattern. If the price of the stock has a certain pattern, then that'll tell me all I need to know about whether I need to buy it or sell it. And so this was developed in the late 1800s. The Dow theory by Charles Dow. He co-founded the Wall Street Journal and Dow Jones Index, which was used largely prior to the S&P becoming popular. He showed that prices moved in trends. And then we had, in the 30s, we had Ralph Nelson Elliott create Elliott wave theory, which talked about the collective psychology of investors creating predictable patterns and trends. And then the 70s really created, with the computers, the ability to have these indicators, more technology, to show you things like moving averages. And most popular I've seen is the relative strength index, the RSI. But essentially it just looks at charts and says, we can predict stock prices. We have a crystal ball because we can look at price patterns. The one I often mention is the head and shoulders. So if you see a stock form a shoulder and then a head, and then as it's forming that second shoulder, you can draw a line on the top of the shoulders. And that's, if it breaks that shoulder a certain way, that's the direction, that's the trend. Academia hates technical trading. It created a theory called efficient markets hypothesis, which said there's no way that could ever be true. If there were trends, people would find them. So let's say the January effect, everyone's like, oh, everyone sells in December for tax reasons and buys in January. So why don't you buy stocks in January and you'll experience a guaranteed lift? So everyone's buying it in January, and then they realize, well, we should buy it in December because everyone's buying in January, so it's already gone up. So then everyone buys in December, and they're like, oh, wait, we should buy it in November because everyone's buying in December. And anyway, it's just the nature of trends. Once they're identified, then they go away. There's no golden goose. There's no like, I will make money. And so obviously you can see my belief in technical trading is limited. I think it's not something you should, I think it tends to be more of a gambling type of behavior. The one thing I will say about technical trade, I do believe in momentum because I believe in greed and fear. And so I think there are trends that happen, particularly when it's frothy, either with excitement or with fear. And so I think if you're looking at moving averages or an RSI, the strength index, that could actually aid you if you know you want to buy or sell something. So if you know you've done the research, you know you want to buy a certain stock, then if you look at kind of these technical indicators, that could tell you, hey, let me do it right now because it's a good time. Or, hey, it looks like it's still going to go down. I could find a better price. So I like it as a way of reducing transaction costs, as they say, so that you can buy lower and sell higher. But I don't want to make my actual buying and selling decisions on a chart and a trend.
All right. Well, thank you, Shane. I think we covered quite a bit today. Thank you. I appreciate your time again for sharing everything. That was a lot of information. I know there's definitely some things I've learned, so I appreciate it. So thank you for taking the time to be here.
Yeah, no, my pleasure. Thanks so much.
Again, if you want to know more about Shane and check out his website and his book, wholeheartfinances.com, you can order the book there or from Amazon and check out his course that's on there. It's really designed, as he said in the last episode, is designed to be used on on your phone, so you can have that experience with it. I think it's very well done, and I think it's a useful tool that you can learn from. Check out his book as well, and we'll see him next time. We have 2 more episodes that we're going to do. I hope you'll join us for that one. Again, thanks for being with us. We'll see you next time on Stewardship Leader.